All right, so welcome to today's session. So we're basically in week 9 already, if I'm correct. So in front of you, you see kind of the schedule for the rest of the semester in the sense that this week, we're effectively finishing all our new content. After this week, there's no more new content. Actually, after today, there's no more new content. On Thursday, we're going to be applying what we learned today, which is really relative valuation. So it's kind of just looking at comparing your firm's value to those of the market and trying to imply what your firm's value should be based on what comparable firms are valued at. Next week is going to be completely dedicated to getting you to finish the group project. I know most of you would have done work every week, but I know that some of you might be a bit behind in terms of writing, or some particular weeks need a bit more tweaking. So that is completely dedicated for the project. So I'll still be here. So I'll be here in class on the Tuesday and on the Thursday session. If you're done, you don't have to attend, but if you still have work to do, if you need to, I guess, ask questions, or even if you just need group time, come here. Yes?
All the presentations going to be on the Tuesday?
Yes, so the presentations are all going to be on the Tuesday. The presentations are maximum 15 minutes. So it's going to be, I would say 10 to 15 minutes is the guideline. After 15, I'll cut you off. So we have about 3, 4, 5, I think we have 6 groups, so that's 90 minutes. Should be possible as long as there's like logistics are all in order. But generally speaking, the presentation is just supposed to give a general overview of your project. It's like an executive summary. So when I say that you should make it 15 minutes max, is basically if you go above 15 minutes, it's very likely that you'll bore the audience. So try to make it not boring, and by making it not boring, you tend to make it shorter and more to the point. So again, you think about it from an executive summary point of view. An executive summary is supposed to more or less summarize the entire document or your entire project so that somebody more or less can avoid reading the entire report. If they're interested in one particular bit, they can go into the report, but the executive summary is supposed to give an overview of your report. Now, you don't have to cover everything in the executive summary, only the things that effectively help you conclude whatever you conclude. So if you decide the price is over or undervalued, that is your conclusion. The executive summary is supposed to basically get us to there. So the presentation is supposed to be able to make us understand why you believe it's under or overvalued. Now, the review session is on Thursday, week 11, because in week 12 and 13, again, it's Commonwealth Games, so no classes. During Commonwealth Games, I won't be on campus, but I will be available over Skype or email. So during my normal consult hours, I'll definitely be on Skype. Anytime outside of my consult hours, just email me, and I'm most likely going to be on Skype because I'm most likely just going to be at home anyway. So generally speaking, during Commonwealth Games, when you study, I do believe that technically our exam actually falls in week 15 perhaps, because it's the Tuesday. So that's not really great, because basically what that means is you have like 3 weeks between the review and the exam. On one hand, it's good to have more time to study. On the other hand, you tend to forget. That's the kind of downside. Again, the review session will be recorded at least. That's good. And again, I will be available for questions and helping you throughout basically the time until the actual exam. Do we have any questions?
Are you able to go through like what we're supposed to do for our presentations, like closer, like sort of?
Yeah, so I'll post a document probably later this week or early next week in terms of actually outlining some guidelines.
Yeah.
But if you think about it, don't make it boring is the takeaway. I know that's a bit fuzzy, but if your friends find it boring, yeah, no, but again, like you're thinking about it from a perspective that you need to tell a story, you need to tell a convincing story. So you have a conclusion, which is that you need to either recommend the shareholders to accept or reject the offer, because that is the whole point of a fairness opinion. And you need to get the audience there as well. So that is your conclusion, but you need to make us essentially believe that conclusion. So generally speaking, when I look at presentations, shorter tends to be better than longer. Obviously, if you know a lot and you can bring it in and still make it interesting, you can make it 15 minutes. But I prefer actually 10 minutes over 15 minutes, because generally speaking, I find the longer ones tend to drag things out.
Is it something where we need to have everyone speak?
Yes, I would prefer if everybody speaks. You do get an individual grade on the presentation. Generally speaking, there will be, again, presentation time. I might ask 1 or 2 questions, but there won't be anything major. In terms of actual content on the presentation, again, I'll post a little guideline, but generally speaking, you don't have to cover everything. So, for example, if your bankruptcy prediction models showed 0% probability of bankruptcy, it's not relevant to include it in the presentation. You only include things that are relevant. If the liquidity ratios are all good, don't go through all of them and show, well, here they're all very, very high. Just make a very quick comment on that instead. So the idea is that if something is not needed in the presentation, you don't have to include it. The most important thing is really your recommendation. So really anything that helps you in that recommendation is what you need to focus on. Other questions?
Maybe with the forecasting with, for example, just the sales growth, would you recommend providing explanations on why you think the sales growth?
Yeah, so I would if we're thinking about, I guess, the key things within each week, so within, I guess, forecasting, I did say, I think sales growth is probably the most important thing to forecast because everything else is based on sales growth. I would try to justify why you believe sales growth should be a certain percentage. And again, to some extent, it's going to be a bit general in the sense you believe you looked at general trends, the industry average, and the company's historical average and all these things, but you need to justify. So if you think about the slide forecasting, probably the most important assumption there is really sales growth and what rate it's going to be growing at. And again, closer we get to the exam, I'll actually, especially I guess once we actually cover the review, I'll post some more information about the final exam. The final exam will have more calculations than the midterm. And generally speaking, the final exam will, I guess, involve more, I guess, calculation in Excel than the midterm. So during the midterm, you might have done some analysis in Excel and use it to write things up. In the final, the actual Excel output will be your answer as well, because if you go through what we've learned so far, again, last week, primarily we learned about how to apply a discounted cash flow model and a residual income model. So it kind of stands to reason that those things might be on the final exam in terms of calculations. But again, I'll post things closer to the final exam. And similar to the midterm, you will have access to a formula sheet, so you don't need to memorize formulas, but you do need to understand them. Questions? All good? Okay, awesome. So again, today is basically we're entering the last topic, which is relative valuation. Now, some of you might have already looked at the homework, some of you have not. Some of you might have forgotten that we do have homework in this class. That's okay. So this week basically marks the end of the homework because this is the last homework that you'll do. This is kind of what you end up with at the end of the homework, which is really just an application of relative valuation for H&M in this case. So relative valuation, and what we're going to be covering today, is really trying to value a company based on comparable firms. And the idea is that similar assets or similar businesses should be valued in a similar way. So kind of the highlight of this week is that you need to find something to compare your firm against. Generally speaking, this will be a select number of companies. So you would have selected a few companies quite a few weeks ago where you, I guess, might have selected them because they're competitors or because maybe they were listed on Bloomberg as similar companies and so on. And those companies can be used to try to imply a value for your own company. Because what you're going to be looking at is trying to value your company as a multiple of something based on how all those other companies are valued. So here, for example, we have an overview of 4 companies. We have Zara, Uniqlo, Gap, Esprit, because it selected those as comparable firms. We have equity value divided by sales, net profit and book value, and then enterprise value divided by sales and EBITDA. So if we just focus on the first part, which is really the equity value divided by sales, net profit, and book value, basically we're presented with 3 different types of price multiples, because equity value is essentially your market capitalization or your share prices in relation to your sales, your net profits, or your book values. For example, Zara is being valued at 22.2 times their net profit. So if their net profit was $1 million, then their market capitalization should be $22.2 million. So all we're looking is trying to understand what multiple are investors willing to pay for these various companies. And based on that, we can then try to figure out what should our potential value be. So we could look at the range of these multiples. We could look at the minimum multiple for sales, for example. So we can see that Esprit is only valued at 0.4 times their sales, which is really, really low. We can see that the maximum multiple here is 2.9, which is Zara. So Zara is valued at 2.9 times their sales. But technically speaking, sales doesn't really tell you much about how much is there at the end of the day to give to the investors. So sales multiple might not be that relevant, generally speaking. So generally speaking, the net profit multiple will probably be the most valuable one to use in this case. And there we can see three multiples ranging from 12 to 20, even 31. We can see that Esprit is blank. And the reason why it's blank is that it's a negative multiple. So Esprit is actually making a loss, which is why we can't include it. So whenever you have a negative multiple, you just delete it and you exclude it. Again, if you have to exclude all of the multiples for all your comparable firms, it creates problems. But if there's only one or two, that's fine. What you start to see here is that there's vastly different multiples in the sense that Gap is being valued at 12 times their earnings, Uniqlo 31 times their earnings, which kind of also highlights the big problem with relative valuation. Because relative valuation completely depends upon the comparable firms being a good comparable firm. In the sense that if Gap is not a great comparable firm to H&M, then this valuation is going to be inaccurate. So if I'm going to look at these four firms, and I'm going to think about H&M as a business model, which is like fast fashion, then most likely Zara and Uniqlo are the best comparables. Whereas if you look at Gap and Esprit, yes, they're clothing retailers that might not be super expensive, but they wouldn't be classified in the same category as H&M, Uniqlo, or Zara, which tend to have very similar, I guess, business models. So in that sense, whenever you include a company here, which is not perfectly comparable to your firm, it's going to create problems. Again, in this particular scenario, I actually have a really nice situation in the sense that H&M actually has pretty good comparable firms, in the sense that Zara and Uniqlo are really good comparable firms. Even though they're not perfect, they're really good because generally speaking, very large firms, publicly listed, will have very few perfectly comparable companies. Because if you think about most publicly listed firms operate in multiple industries. They might, even if they operate in one particular industry, it might be because they're a dominant player in that particular region. So there's no other company in that particular region that you can compare yourself against. So if you think about, I guess, Time Warner or Fox or whoever, these companies are entertainment companies, but one of these companies might be more focused on internet content, the other one on their cable business. A third one, like Disney, might be more into movie production. So even though they're in the same industry, doesn't mean they're going to be perfect comparable firms. So in that sense, it becomes very difficult to figure out what is a good comparable firm. And in most cases, you're not going to find perfect companies. So when you see very different multiples, it generally implies that the companies are different. So in the sense that I see that the multiple for Zara and Uniqlo, if I look at all these multiples, they're pretty similar to each other. They're different, but they're at least closer to each other than Gap or Esprit, which tells me a bit about the fact that perhaps Zara and Uniqlo are similar to each other, and Gap and Esprit might be more similar to each other than the other two. But again, basically what this means is that there's really no good way to select a perfect company because you won't find a perfect comparable company. You'll find your best potential option, and you kind of need to stick with it. And then if you find that you're getting funny results, then you can usually explain it by the fact that you have, I guess, comparable firms that are not perfectly comparable to your own business. So how this works is that you essentially will find a mean or a median multiple from your comparable firms, and then you multiply it by the values of your own business. So for example, for sales for H&M had about 217 billion Swedish kroners in sales. So a sales multiple would basically take the mean multiple of sales, 1.6, multiplied by the number of sales of H&M, and you get an equity value. You then divide it by the numbers of shares to get to the share value, which is what you've done actually down here. So it's the multiple by the actual sales divided by the numbers of shares. And that's kind of how it works. So again, this week, and I guess what we're going to be doing today, is really going through some of these various multiples and discussing when to use them. Because really the highlight of this week is understanding that relative valuation is good in some instances, but because we do have many different multiples to choose from, we need to know which one is going to be more relevant in which situation. That's kind of the difficult part. Because if you're looking at price to sales multiple, I said that it's maybe not the greatest multiple because sales doesn't tell me anything about how much we're actually giving to the shareholders in terms of earnings. But in certain instances, price to sales multiple is the most appropriate one. So it's really trying to understand when to use what. So again, relative valuation, it's really just looking at modeling the value of one asset relative to that of another asset. And the underlying idea is that you essentially are trying to look at the idea that similar assets should sell at similar prices. Again, similar to intrinsic valuation, it's not always going to be equal to market price. And when we're going to be implementing it, we are going to be using price or enterprise value multiples. Now, you might ask yourself, why should we use relative valuation? Or actually, let's just ask, so would relative valuation or intrinsic valuation be a better approach? This question was actually asked in the midterm.
Relative valuation is probably a bit easier.
Yeah, so it's easier. So what about intrinsic? Is there anything pro or advantages of using intrinsic valuation?
Maybe better long term for bigger long-term investments.
But basically, so if you have a long-term investment, you will probably be more invested in it in the sense that you will try to learn a bit more about the company. So intrinsic valuation is great, and it's generally preferred from a theoretical point of view because you're actually looking at the returns and the risks and so on. But it kind of requires you to know a lot about the company, which takes time, takes resources. So if you actually don't know a lot about a company, relative valuation might be preferable. Because if you don't know a lot about a company and try to use intrinsic valuation, you're just guessing. So generally speaking, relative valuation, the advantage is basically it's quick. It's a very nice little way to, I guess, quickly value a company. But also when you don't know anything about the business, use relative valuation. The drawback is obviously when you use relative valuation, you're valuing your firm similarly to how other comparable firms are valued. So if other firms in the market are overvalued, you will overvalue your own firm. If other firms in the market are undervalued on average, you're going to have the exact same problem. So you're kind of implying in the sense that you're more or less relying on the market participants to do the right thing. So whenever you have an undervalued or overvalued or undervalued stock market, you're going to have some issues with your relative valuation. So when we're looking at this week, and again, this week is really just trying to understand what are the various multiples that are most commonly used, what do they do, and what are some of the kind of potential rationales for using it and the drawbacks. Because these will kind of tell you about when you should use one or the other. So in the homework, I had, I think, 5 different ratios, 5 different multiples that I used. 3 of them were equity-based multiples in the sense that they're looking at the price, and 2 of them were looking at enterprise value. So if you remember when we looked at last week, we talked about the differences between enterprise value and the equity value, in the sense that when we're looking at equity value or price, we're only looking at the claim of the common shareholders. So we're looking at the share price, and that is kind of what we're, I guess, highlighting. When we're looking at the enterprise value, well, that's the entire capital base of the firm. But other people might have a claim on it, such as creditors. So again, it's similar to, I think I made the example last week. If you think about the fact that you own a house, you have a mortgage, well, because you have a mortgage, your equity value is not going to be equal to the actual price of the house. So if the value of the house is $1 million, and you still owe 700,000 to the bank, your equity value is going to be 300,000. But the enterprise value is the entire value of that house. But again, the value of the house and your equity value is going to be different because you owe some money to your creditors. Again, if you only have common shareholders and you don't have any kind of outside claimants such as creditors, well then these tend to be very similar. So the most commonly used equity multiple is the price to earnings multiple. So when you read financial press, sometimes they might talk about PE ratios in the sense that they might say that Woolworth's PE is 15, it's gone up to 17 or whatever, and this indicates that it's overvalued or undervalued. What they're talking about is the price to earnings multiple. And the price to earnings multiple basically looks at your net profit, or sometimes it's looked at in a per share basis, such as earnings per share, or basically net profit per share, in relation to your equity value. And again, equity value and the share price are the exactly same thing. So when we're looking at earnings per share, it's going to be compared to the share price because that's also on a per share basis. If you're instead going to be looking at your entire net profit, well, then you need to compare it to the market capitalization. So either you do it on a per share basis or you do it on the entire market capitalization basis. So the general idea behind the price to earnings multiple is really that people are obsessed with earnings because generally speaking, when we're thinking about the purpose of the business, it's really to create shareholder wealth. And the way that companies do it is by generating profits, not only now, but in the long term. So when we're looking at financial press, generally speaking, they will be heavily focused on the earnings. So what is the earnings or what is the profit of the business in this particular quarter, in this particular year? Because everybody's obsessed with it, it actually stands to reason that we should probably look at earnings as a multiple measure in the sense that how can we value a firm as a multiple of its earnings since everybody's so obsessed with earnings. So the general idea is really that earnings per share or profits is a driver of value. It's widely used by the financial press. And people have done research and showed that current earnings is related to stock returns in the sense that you can use the company's current earnings to try to predict the future stock returns. So if you can predict future stock returns, then that kind of implies that you need to consider it in a valuation context. Again, generally speaking, price to earnings is the most commonly used multiple, but there are particular drawbacks which sometimes mean that you can't use it. So whenever you have zero, negative, or very small earnings, it's gonna screw things up in the sense that when we're looking at companies with zero earnings, well, you can't get a price to earnings multiple. If you have negative earnings, your multiple is gonna be negative. Once you have a negative multiple, you can't use it. So if all your comparable firms have negative earnings, well, then you can't use a price to earnings multiple. Even when you have very small earnings, it's still going to present problems because even though it looks like a positive number, it means nothing. So let's say, for example, in this case, we have, let's say the share price of a company is $10 a share and its earnings per share is 1, which means that the earnings price to earnings multiple should be 10. Now, let's say in the other instance, we have the situation where we have a share price of 10, but an earnings per share of 0.0001. So they barely made a profit, but they made like $1 profit or whatever. Once you do that, you get a price to earnings multiple of about like 100,000. If you then apply that 100,000 without thinking too much about it, you're going to be valuing H&M in this case 100 times their own earnings. So whenever you have a very small multiple, it's going to completely bias, or sorry, a very high multiple, it tends to imply that the company is not actually valued on its earnings. It's valued based on something else. So what I would look at is specifically if you see a very high price to earnings multiple, it might indicate that 1, you made some mistake. 2, it could indicate that the company is not valued based on their earnings whatsoever. Or 3, which is really quite unusual when you see an extreme value, is that the market thinks the company is amazing. If the market thinks that the company is amazing, that they have huge growth prospects, you tend to see a high multiple. But sometimes it's difficult to understand when the high multiple becomes a extreme multiple, which would imply that they're not being valued based on their earnings whatsoever. So again, when we're looking at price to earnings multiple, small numbers, negative numbers, zeros make it more or less unusable. We also have some issues around accounting information. So earnings is an accounting number, which means that all the usual problems with accounting information kind of go hand in hand here. So we do have the issue around management discretion in the sense that management can more or less determine earnings from year to year, depending on the choices that they make when it comes to the accounting for certain assets, liabilities, try to, have aggressive revenue recognition and so on. So to some extent, the earnings figure can't be completely trusted. You also have the issue around permanent versus transitory earnings in the sense that some earnings are going to be one-off. Other earnings components are going to be permanent. So if you're thinking about, a company's profit, if the profit is all based on transitory earnings, and you're using it to figure out what the multiple of that company is, well, that's going to be incorrect because the market is not necessarily going to be valuing transitory earnings in the same way that it's going to be valuing permanent earnings. So the general idea is the market prefers if your earnings components are going to be long-term, they're going to persist over time, and they're going to continue. Whereas transitory earnings, in the sense that they're just happening this year, perhaps because you made a huge gain on the sale of an asset, well, that's great for this year, but it doesn't tell me anything about what's going to happen next year. So I don't know that this particular profit is going to continue on in the future. So whenever we apply a price to earnings multiple, you can do it in two different ways. So you can either use a trailing price to earnings multiple or a forward price to earnings multiple. Technically, this applies to all the other multiples that we're looking at today. So you can either go back in time or you can go ahead in time. In the sense that if you start thinking about it, so price to earnings, so we're looking at the share price in relation to the earnings of a firm. So trailing or forward just means are we going to be looking at last year's earnings or future earnings, so next year's earnings. So what would be the idea of why should we look at future earnings? What do shareholders make their decisions based on? The past or their expectations? Expectations. So because they tend to use expectations in their decision making, people tend to prefer a forward multiple in the sense that when we value a firm, we want to value it based on the future kind of expectations of that firm. Again, not every firm will have a forecast associated with it. So generally speaking, you can find the future earnings for firms which have an analyst following, in the sense that some people out there are valuing these on a regular basis, they're forecasting their financial statements on a regular basis, and they might provide this forecast to the public. If you don't have that, you might need to use a trailing price to earnings multiple. So again, generally speaking, if there's no big difference between last year's earnings and next year's earnings, it's not going to matter which one you use. But if you do know that the company is changing drastically from last year to next year, then you need to always use a forward multiple, because when you expect huge change, well, then the market is going to be valuing the firm based on the changed kind of conditions that are going to be occurring in the future. So again, generally speaking, you want to use forward multiples whenever you can. If you don't have the information, well, then you might need to use a trailing multiple. And again, sometimes it's going to make a difference, sometimes it's not. So in this example, we have kind of an example of what happens when you either use a forward or a trailing multiple. And it also highlights that you can technically calculate a forward multiple in a number of different ways. So here we have an example of a company where we have the stock price, which is $20 per share, and then we have their earnings per share, which are historical, and some in the future. In this particular scenario, we are assuming that we're in the beginning of December 2016. So if we're in the beginning of December 2016, and this company follows the traditional financial year, which is, I guess, until the December 31st, It means that the historical figures for in our particular case are the first 3 quarters of 2016. Everything else is future oriented in the sense that these are all forecasts. So the 35 cents for 2016 is a forecast. These all numbers are forecasted for the future. So we can then calculate a forward multiple in a number of different ways. So we can either look at the next 4 quarters, which basically looks at quarter 4 because that has not ended yet, and then quarter 1, 2, and 3, sum them up, and you get the forward earnings per share based on the next 4 quarters. So again, sum up all the 4 quarters and you get an earnings per share. Divide the current share price by the actual earnings of the firm, so earnings per share that you calculated, and you get a multiple of 11.4. So essentially, they're valued at 11.4 times their forward earning, in the sense that they, based on what we expect for the next 4 quarters, they're valued at 11.4 times that. But on the other hand, you could also look at the next 12 months. And the next 12 months basically looks at it from a monthly perspective, in the sense that we know that technically speaking, we are in December. Because we're in December, perhaps using, I guess, the entire quarter might not be that relevant because already 2 months have passed. So what you can do instead is you can try to figure out on a monthly basis. So there's a few different approaches. One approach is to just take the amount of months that is left in the prior year. So in this case, if we're in December, we have 1 month left. So we're going to take 1/12 of the 110 for this year, and we're going to take 11/12 for the $2 forecast for next year. And again, based on this, we're going to get a slightly different number, which is going to be 1.925. Again, these are both forward multiples, so they tend to be quite similar in the sense that even though one might use a quarterly basis, the other one might use a monthly basis, they're going to be quite similar because they're forward oriented. But because I can see that, for example, the fiscal year forecast for 2016 and 17 is vastly different, almost double, I know that the forward multiple is going to be very different from the trailing multiple. So whenever you have huge changes in earnings from year to year, there's going to be difference between trailing and forward multiples. So if you wanted to calculate a trailing multiple, you could base it on the, the current financial fiscal year, so which is, forecasted to end at 110 per share. So in the sense that they're forecasted to earn $1.10 per share for the year of 2016. If you do this, well, then you get a PE ratio of 18.2. If you instead look at a forward multiple based on the entire next financial year, you get a PE multiple of 10. So essentially what you see here is 2 vastly different numbers. So if you try to observe this company as a comparable firm, and you either calculate the trailing or a forward multiple, you're going to get different answers. So for example, if your own firm has let's say $1 million in earnings, if you use the forward multiple, you would value your own firm at 10 million. If you use the trailing multiple, you would value it at 18.2 million. So again, very different numbers. So whenever you have huge changes in earnings from year to year, there's going to be a difference between using either of these two. Again, which one should you use? Generally speaking, the forward multiple almost always will give you the right answer. Can anybody think of when you might not want to use a forward multiple, even though there's changes? So there's been a change from year to year, but is there any reason why we might not use the forward multiple?
I think it's really uncertain.
Kinda, yeah, that's good. So uncertainty, but really what we're kind of looking for is this particular component. So this is kind of around uncertainty in the sense that if the future forecast for this year, for the 2017, it is $2, so it's double, but it's just a one-off earnings. So it's not going to kind of persist into the future. In that particular instance, it might actually be better to use $1.10. So what we always need to consider is, technically speaking, yes, forward multiples generally are preferred, but there might be instances when even a forward multiple is not relevant and you might actually use a trailing multiple. So whenever we have, earnings per share and price to earnings, there's going to be some issues around how we calculate the various inputs. So one of the issues that we do have is around EPS dilution. So EPS dilution just means that whenever we calculate earnings per share, we take your net profit and we divide it by the numbers of shares outstanding. The problem is that the amount of shares outstanding that the company reports is not actually the amount of shares that are truly outstanding, in the sense that companies do have shares that are currently out there that are issued, but they might have a huge amount of options out there which might be exercised in the future. They might have warrants, they might have convertible instruments, which might mean that the true numbers of shares out there is actually much greater. So what we can do in this particular instance is to then look at how many shares the company has using a diluted basis, in the sense that diluted numbers of shares outstanding is also a metric that some companies report. Again, sometimes the diluted numbers of shares and the actual numbers of shares outstanding might be very similar because the company doesn't have a lot of options, warrants, and all these instruments. But if the company uses a lot of these kind of instruments, well, there's going to be a huge difference. In this case, you will prefer to use a diluted numbers of shares metric. And again, both of these are reported on Bloomberg. We do have some issues around underlying earnings, in the sense that underlying earnings generally kind of refers to the permanent or the transitory nature of the earning. So just because, again, in the last example, just because the future forecast for next year is $2 doesn't mean we're going to use that $2 in our multiple. We might actually adjust it to figure out what is the true underlying earnings underneath all this. We might also look at normalized earnings. And normalized earnings basically looks at the past few years to try to understand what is a normal earnings level. And then finally, because we are dealing with earnings, if there are differences in the accounting methods between firms, it's going to be creating some form of problems for you when you want to compare them. So if one firm, for example, is in a jurisdiction which allows you to capitalize R&D, so essentially you can more or less consider it an asset and you don't need to expense it all in 1 year, well, then you're going to have issues comparing it to a firm in a different jurisdiction that might not have that option. So whenever two companies are in different jurisdictions that will have different accounting methods, it's going to create problems if those accounting methods hugely impact the reported earnings. So we have the example of underlying earnings, and what does that underlying earnings mean? Well, underlying earnings just means that you're trying to figure out what is the true permanent value of the earnings. So just because in this particular example, the earnings per share for the previous 4 quarters is $4 per share, doesn't mean that you need to use that $4 in an actual multiple. Because if you know a lot about the company, you might know that there are restructuring charges, there might be amortization of intangibles, which technically doesn't happen a lot these days, but there might be, for example, impairment charges. Because all these three could potentially be irrelevant for the future in the sense that they might not be relevant to try to understand what the true underlying earnings is, you might want to adjust for it. And there is no standardized way to adjust for these things. It's basically whatever you think is going to be a permanent figure in comparison to what is going to be transitory in this case. So this slide basically presents 2 different methods to do things. One is reported core earnings, which is really basically borrows on the concept which is created by Standard & Poor's. So if you remember, Standard & Poor's is used quite widely. So we do have Standard & Poor's, I guess, the stock indexes and all these various things. One of the other things that they've done is they've actually created a earnings measure themselves. So instead of accounting profit, they call it S&P core earnings. And S&P core earnings basically means that you take the accounting profit and then you adjust it to the true underlying value of earnings, which is more or less supposed to be permanent. And what you do in this case is you essentially look at your earnings of $4 per share, and then you add back any transitory components. So for example, if we have one-off items which will not continue into the future, and these all 3 decrease our profits that were reported, then we just add them back. So we basically take that $4 and then add back all 3. Again, Standard & Poor's, you can basically Google it and you can see all the items they tend to, I guess, either add or subtract, but there's a standardized methodology. But generally speaking, when we're looking at underlying earnings, there's no standardization in the sense that underlying earnings are whatever you decide them to be. So you can more or less decide, well, maybe by looking at all these three, or maybe this company has had restructuring charges for the last 10 years. So it's not necessarily a one-off item if they continuously do it year after year. But you might believe that perhaps impairment charges are truly a one-off item and they won't happen in the next few years, in which case you might just adjust for that. But again, there's no right or wrong answer here. It's more or less what you can justify as being a one-off item that will not continue into the future. So you're looking at just figuring out, okay, so which ones of these are one-off items, which one of these will most likely persist in the future as well. So in this case, you might say, well, it might be the impairment charge, so I might only add back the impairment charge. Yes?
So the underlying, you just pretty much choose whatever.
So you can more or less decide whatever you want to do. There is no guideline. Generally speaking, you will be adjusting for items that are similar to the core earnings concept developed by Standard & Poor's, but you might be more picky. So you're not going to use a standardized formula. You're going to be using your own judgment in this case. And again, depending on what you choose, it's going to have slightly different impact. So if you're going to look at the price to earnings multiple based on the reported earnings, it might be 12.5. Based on the core earnings, might be 11.2, and underlying earnings 11.9. Again, not huge differences, but there are differences in terms of what you get at the end. We also had the concept of normalized earnings. So normalized earnings just refers to the idea that technically if the current year earnings is not necessarily reflective of what we normally perform at, so maybe we made a loss, or maybe we made a huge profit, can we instead look at a normalized figure? And a normalized figure just goes back in time to try to understand what is a normal level for our earnings or for a normal level for our return. And there are two different approaches. One approach is that you could look at the earnings themselves, in the sense that you could look at the earnings per shares and figure out what is an average level of earnings per share for a company. Or you could, for example, look at the ratio of return on equity and figure out what is the average return on equity for a company. And the idea here is that a return on equity approach might be better if your book value per share has increased over time. And you'll see kind of in this particular example. So again, the first approach, you're just looking at the past 5 years worth of earnings per share, and you're dividing it by 5. And you get, in this case, 0.618 in terms of 0.618 earning per share. You can then, I guess, divide the current stock price of $24 by this amount, and you get a price to earnings multiple of 38.8. Again, on the other hand, this might not be a great approach because technically speaking, this earnings is driven by the assets of the business. In a sense, the business uses their assets to generate sales, which then are turned into profits. If the firm's assets have grown over time, so its book value has grown, we tend to expect a larger earnings kind of to reflect that. So to solve for this, what you can do instead is to look at the return on equity instead. So basically you go back the past 5 years, you look at the average return on equity, you figure out what the percentages is, and in this particular case, the average return on equity is 22.8%, and you then multiply it by the current equity book value per share, which is $4.11. In which case, you get a normalized earnings per share of 0.937, which means the PE ratio in this case will be 25.6. So again, there's a different approach compared to this, but you get very vastly different numbers in the sense that this approach gives you a PE of 38.8, the other one 25.6. They're both trying to normalize earnings, but they get vastly different numbers depending on the approach. So again, whenever we do relative valuation, it becomes very tricky in the sense that small changes in your methodology might create quite large effects on the actual ratio. So whenever we do, I guess, all these kind of comparable firm valuation, whenever we do relative valuation, one of the things that you do need to do is to benchmark your firm against something else, in the sense that you need to find comparable firms to compare your firm against. And when we're looking at this, there's a few different approaches for your project. The most likely approach is to just select a few industry peers. So for H&M, I selected 4 peers. I looked at Zara, Gap, Uniqlo, and Esprit. So what this kind of suggests is that I'm just looking at a few select companies that I think are the most similar to my firm. On the other hand, what you can do is kind of go a bit broader in the sense you could look at the entire industry. In the sense that I could look at the stock market and look at all the publicly listed clothing retailers and basically compare my value to them. Basically, I'm gonna looking at using the entire industry as my comparable kind of company universe. On the other hand, you could also go even further and say I'm gonna look at all listed companies out there. Basically what that means is you have a bigger sample. So basically as you go to the right from, I guess, select industry peers to industry to broad market index, you have a lot bigger sample in the sense that there's probably thousands upon thousands listed firms out there. But the kind of downside is that you don't necessarily have perfect comparables. So you might be trying to value H&M based on how a car manufacturer is valued, which makes no sense. So generally speaking, nobody does this. People might do industry or sector indices. This is actually not too bad of an idea when you can find a great comparable firm. So the select industry peers are just finding just 3 or 4 comparable firms. Works great if those are truly comparable to your firm. If they're not, you might as well just basically look at the industry mean or industry basically or sector index. So what you're trying to understand is what is the industry on average valued at. And then finally, we have the idea of just looking at your own firm's historical values, in the sense that your own firm is technically the best comparable firm to yourself. So if you know how you've been valued in the past, you could use that information to imply how you should be valued in the future. Question, do you guys want to break? Mm-hmm. All right, so come back in 10 minutes and we'll continue. All right, so we'll continue on with the lecture. So basically where we stopped was talking about the fact you can choose a number of different methods to select comparable firms. So you can either go with select industry peers, the entire market itself, or something in between where you're just looking at one sector or one industry. Or on the other hand, you can even just look at your own firm's historical values. So the general idea is that you're trying to find a firm that is comparable to your own to basically try to find the most similar firm to your own. The problem is that generally firms are not identical. So relative valuation basically is underpinned of the assumption of law of one price, in the sense that similar assets should be valued in similar ways. In reality, companies are vastly different. Again, whenever you have a company becomes larger and larger and larger, it tends to become very different from other large companies. So in H&M's case, it's quite unusual that you actually have such a large company that is in one particular industry and is not in kind of sub-industries or slightly diversified. So in Euro cases, so we have, let's see, we have Mantra, which is property group kind of developer. Are they a developer or not? Are they just own and operate?
Yeah, they just own and operate.
So they own and operate. You have a developer / operator with Westfield. You have some entertainment companies. You have like a restaurant company. They're vastly different in how they, I guess, execute your businesses. So just because your company is, let's say, the restaurant company, so Buffalo Wild Wings, it's going to be vastly different to another restaurant company. So just because there are 2 restaurant companies, they only do restaurants, does not mean they can be perfectly compared. So they can't necessarily just be compared to McDonald's because it's vastly different. So the problem around the multiples is really the idea that companies are not identical. So generally speaking, you could do something which is called a price to earnings to growth ratio to adjust some of the risk and earnings growth kind of expectations. So one reason why multiples will be different is because of growth expectations, in the sense that higher multiples are usually seen for companies that you expect to grow quite a lot in the future. If the company is very risky, it might actually decrease the multiple. So because of these issues, some people try to adjust for it, and one of the ways that you can adjust for growth is to use a price to earnings to growth ratio. So price to earnings to growth ratio basically just compares your price to earnings multiple to that of your growth. So in this particular instance, we have an example with the company which has a 5-year earnings per share growth rate of 8%. The forecast for earnings per share is $4.50, and the current stock price is $28. We then have the values for the peer group, which is the median price to earnings is $9, and the median price to earnings to growth ratio is 1.6. So what you need to do first is to just calculate the price to earnings ratio, which is really just the share price divided by the forecasted earnings per share, which is $4.50. You get a price to earnings ratio of 6.2. The price to earnings to growth ratio then takes that number and divides it by the company's growth rate, which is in this case, we were told it's 8% for the last 5 years, which gives you a price to earnings to growth ratio of 0.78. Generally speaking, when we're looking at price to earnings to growth ratios, a ratio of less than 1 implies that the company might be undervalued. A ratio of above 1 implies that it might be overvalued. So whenever we see a price to earnings to growth ratio of 0.78, it generally means that the company might, to some extent, be undervalued. So how would you apply the valuation in this case? Well, in this case, you might, for example, use the median price to earnings ratio of 9. So you take that 9 multiplied by the forecasted earnings per share, and you get $40.50. Now that $40.50 is a value in itself, in the sense that that is what you believe the value could be. But I know that my price to earnings to growth is 0.78. The industry median is 1.6. So it seems that the companies in my industry group, so in my peer group, and myself were valued very differently. So it might not actually be that applicable to use the median price to earnings ratio for the peer group. Because again, whenever we see the differences in price to earnings to growth ratios, it generally implies that the companies are also going to be valued slightly differently. So in our case, it looks like our company is undervalued. The industry, on the other hand, looks like it's overvalued. Yes?
So that $40.50 is what you predict the share price value to be, or is that?
Yeah, so that's what you believe the value of the firm share price is, based on the median price to earnings ratio of your peer group. But this median might not be that applicable to you because it looks like the industry or the peer group might be overvalued in relation to their growth.
And you get that median PE from Bloomberg?
Yes, you can get it from Bloomberg, or you can just calculate it yourself, in a sense that you calculate the PE ratio and then you compare it to the average or median growth rate for the industry or the peer group. So again, whenever we're looking at all these multiples, it does to some extent kind of more or less rely on the fact that we have great comparable firms. If we don't, it becomes much more difficult to start using relative valuation. So again, whenever we have to select different companies or selecting, I guess, values within a range. So in the sense that for the homework, I think I selected like 4 firms. For your own project, you might have like 3 or 4 or 5 comparable firms. In that case, it's not necessarily that big of a deal to use a mean or a median, but sometimes it might. So whenever or let's see how much you remember from your statistics. So when does it matter to use a mean versus median?
So when you like outliers?
Yeah, outliers. So whenever you have like a huge number in one direction, it's much better to use a median. So a median basically will just look at the midpoint, so the middle value, instead of looking at the average value. So generally speaking, medians will be preferred over means when there are outliers. If there are no outliers, they tend to be quite similar. Again, when we're looking for, I guess, comparable firms, and I guess when we're comparing ourselves to the industry or even the broad market index, you might have some issues with respect to size, in the sense that you might be comparing your firm to firms that are much larger or much smaller, in which particular instance it becomes very difficult to value your firm in accordance to them. Because technically speaking, on one issue, say for example the peer group here, or actually let's take the homework example. So the peer group for the homework is, we have 4 companies: Zara, Uniqlo, Gap, and Esprit. I think back in the cost of capital, we have the equity value for each particular firm here. So let's see if I zoom in a bit. So are these companies equally large? No. So would taking their average multiple be appropriate, or should we maybe use a weighted multiple? So you could, for example, say that Zara in this case is more or less, what does it look like? Almost 70 or 80% of, if you total that all up. So you might say, I'm going to take 80% of Zara's price to earnings multiple plus like 5% of Uniqlo's and so on. So the idea is that you try to weight it somehow. So the problem is, again, whenever you use an industry or whenever you start to use a broad market index, you might need to start adjusting based on size, in the sense that you might want to make sure that the large companies have a larger influence rather than very tiny companies also being included there. So again, there are a few different issues. I did mention that using your own firm might also be a good idea, in the sense that, technically speaking, your own firm is your best comparable. The only issue here is really if your firm has changed. So you can go back in time and look at what was our price to earnings multiple for the last 5 years, and that might give you an indication. You might even look at using some form of a method like looking at the average 4 middle values of the past 10 years, or the 5-year average. So there's no, right way to do this. You're basically just trying to use your own firm as the benchmark here. But again, your own firm, using it as a benchmark only makes sense if your firm is still the same as it was 10 years ago. If there's been a huge change in the business, the leverage, interest rates, or anything that might impact future profits, or basically means that your past performance might not be indicative of future performance, it's not going to be that relevant to use your own firm.
Yes. It needs to be at least 10 years.
No, there's no general rule when it comes to how many years you need to look at. So whenever you're looking at using your own firm as the benchmark, you don't have to go back 10 years. You could go back 5 years. You could go back 3 years. There's no general rule. All it means is you're trying to understand what your firm was valued at in the past. And if the firm is actually the same as it was 3 years ago and it's valued vastly differently, then it might be that it's overvalued or undervalued right now. So basically just using another kind of point of observation, in this case, yourself. So far we basically just looked at one particular multiple, but there are effectively, let's look at how many we had in the homework. We had 5 multiples, I believe. So far we've only looked at the price to earnings multiple, which is kind of the middle one here. But we also have price to book value, we have price to sales, and then we have enterprise value multiples. Now, generally speaking, all the issues around trailing forward issues, they apply to all of them. All the issues around selecting a good comparable firm, again, they apply to all of them. For the next few slides, we're going to be going through some of the alternative multiples that you could use. And the highlight here is trying to understand when to use it. So what are some of the potential advantages and drawbacks? So the price to book value multiple is another multiple you could use. And generally speaking, you would use it when the company's earnings are negative. So when the company's earnings are negative, it means that you can't use a price to earnings multiple, in which case you might use a book value multiple because book value is usually positive. It's also more stable than earnings per share. So one of the issues around earnings per share is trying to normalize it if you have huge ups and downs. Yes?
What is the book value of?
Sorry?
What is the book value of? Is it of assets? Or is
Yeah, so just your company, in the sense that you take your assets minus your liabilities, gives your book value or your equity portion. So again, generally speaking, it will be more stable, so you don't need to normalize things. It will be appropriate for firms that have very liquid assets, because technically speaking, if you're looking at a financial firm, which might have huge amounts of financial instruments, if they're all valued at fair value, just summing them all up, that will basically be equal to the value of your firm to some extent. So when we're looking at book value multiples, they are appropriate in certain instances, like again, whenever you have earnings per share that's not positive, so you have negative earnings per share, you can't use a PE multiple. It is also very relevant for firms that will terminate, in the sense that if you have a firm that will terminate, it makes no sense to value it based on its earnings, in the sense that a price to earnings multiple basically works on expectations of future earnings. If there's no future earnings, well then you might need to use a price to book value multiple because you know that it's going to be terminated. So the idea here is really that the firm should be at least valued at its book value and maybe as a multiple of it. The multiple of it will be based on future expectations, but also based on the fact that your book value it tends to be understated in most cases. So if you think about all the accounting conservatism issues, they tend to lead to understated book values. And again, similar to earnings, book values can also explain stock returns. So it is kind of relevant for stock market participants. Again, there are a few different drawbacks. So one is that book value does not recognize non-physical assets. So all your intangibles, which are not on here, like brand values or human capital and all these things, they will not be valued using a price to book value multiple. So if the company does have a huge amount of those, the multiple will be different from that of a company that has everything on the balance sheet. So again, when we're looking at all these issues, it tends to be because of accounting practices. So whenever you have differences in accounting practices, specifically between different countries as well, it becomes very difficult to start to use price to book value multiples. Even when you have, I guess, two companies in the same country, in the same industry, if the asset age differs, it will create problems in the sense that if you have different asset ages, you will have issues with historical cost versus fair value. Because if you remember from your accounting theory, from your other classes, when you have an asset, you can value it at fair value, but a lot of the times you can just keep it at historical cost. So if you purchase something that is appreciated in value over time and you still keep it at historical cost, and somebody else purchases the same thing 5 years after you, you're going to be valuing it slightly different values, even though it's the exact same asset. Whenever you have, I guess, share issuances or repurchases, basically you're buying back shares, it's also going to affect your price to book value multiple. Generally speaking, this will affect both, I should say almost every price multiple, in the sense that you're buying back shares, there's going to be less shares outstanding. So when you divide your earnings by the numbers of shares, you're going to get a different number. But also because you're using your own money to buy back the shares. But the idea here is that price to book value, again, mainly useful for when the firm will terminate, when the firm has, I guess, negative earnings per share, in which case you know the book values tend to be positive, so maybe I should use those. Again, that's just one particular option. When you have, I guess, a book value and you want to use a multiple of book value, you might need to do a few certain adjustments in the sense that we know that most of the drawbacks are around accounting issues, so we can try to address them by adjusting for them. So for example, if you know that the firm has a huge amount of brand value, well, you can adjust for it in the sense that you basically use a book value that has been adjusted for the unrecognized brand value. Again, how do you do it? You basically, I shouldn't say guess, but you basically try to value the brand value yourself and then add it to the book value, and that creates the new book value. In countries when you have different inventory accounting, so in the US you can use last in, first out, or first in, first out, you might need to adjust for these things. Even when we're looking at things like off-balance sheet items. Again, these days it's becoming less and less of an issue because most accounting standards these days require you to bring in a lot of the off-balance sheet items onto the books. So previously you could basically have a lot of leases off the balance sheet, now you have to bring them in. And similarly, fair value, which is really quite a big issue if you have a lot of assets that have grown over time in value, but that value is not reflected on the balance sheet. So again, if you buy a piece of land here on the Gold Coast 100 years ago for like $10, and it might be worth like $1 billion now, based on historical cost versus fair value, it's going to give you a vastly different number. So you might need to adjust for this. Again, a lot of these things are not easy to do because you actually need to know quite a lot about the company in order to do any of these adjustments. So again, when we have the situation, we might instead say, well, if we have a bunch of problems with the book value and we have negative earnings, maybe we can just use something else because we don't want to go through this entire process. In which case you might use a price to sales multiple. And the idea here is that it's another benchmark multiple that you can use. So you're basically comparing the firm's price to that of its sales. The idea behind why you might want to use a price to sales multiple is that one, sales will always be positive because there are instances when book values are negative. So when book values and earnings are negative, you can't use either of those. You might actually use a sales multiple. The second idea is that sales are less easily manipulated. So yes, you can have aggressive revenue recognition, but sales only contains that line item. Whereas when we're looking at net profits, there's many different line items where you could have management manipulation. So again, when we're looking at price to sales, it tends to be appropriate for certain types of businesses. So for one, it is appropriate for mature companies in the sense that if your firm is mature, it tends to have a steady numbers of sales in the sense that you might have a steady, sales over time. You tend to also have stability, which means that your earnings might be a bit easier to forecast for the future. But generally speaking, your price to sales will be appropriate for mature companies. It might also be appropriate for cyclical or distressed firms if they kind of fulfill certain criteria. So for example, when it comes to cyclical firms, in a sense that the firm might be going up and down with the economy or based on seasons, you might be using a price to sales multiple that is normalized over time. So instead of just looking at one particular years of sales, you might go back 3, 4 years or 4 quarters if it's just seasonal from quarter to quarter. So you're trying to more or less get it to a good position. And then again, distressed firms generally have problems with expense management. So just because you're distressed doesn't mean you don't have sales. So you still have sales. So you might actually be valued based on your sales even though you're distressed. Again, generally speaking, price to sales, similar to price to book, tends to be more stable than price to earnings. And again, like the two others, they can also explain stock returns. But again, price to sales generally is the worst one you can use. But if you have negative book values, you have negative earnings, you really don't have many other options. The problem when we're looking at price to sales is that it is a pretty bad metric or a multiple because one, sales does not tell me about profits in the sense that I don't know how much we're going to be getting in the end because it basically does not reflect any of the cost differences. So if I'm going to be looking at comparable firms and looking at their multiples based on their sales, those multiples are going to be reflecting their cost differences. So some of them have very good expense management, which means that they have a higher multiple. Others have a bad expense management. You also have some issues around accounting practices. So even though it's hard to manipulate, you do still have issues around aggressive revenue recognition. So again, if people prepay you in advance, you can just be aggressive and say, well, I've actually earned it ahead of time. You do have some issues around the numerator and the denominator. So can anybody think of why these are not consistent? So why is price and sales different? There's no bad guess here. All right, so no guesses. So price is your market capitalization basically divided by the numbers of shares outstanding. So it's kind of what the share price is. Now that share price represents the claim of the common shareholders. So it's only the common shareholders and that's their claim. Sales, on the other hand, is technically available to all capital providers because it's before you pay your banks, it's before you pay all the other people. So net profits is basically, again, net profits would represent a consistent numerator and denominator because net profits is distributable to common shareholders, whereas sales is distributable to both the common shareholders and the creditors. So in this case, they're not consistent. So because of this, you might not necessarily want to use a price to sales multiple. So again, price to sales, usually you would use this as a last resort. You tend to avoid it because again, sales doesn't mean anything to do with your earnings because you really don't know what the returns are. And it even doesn't tell you anything about the cash flows. So you don't know whether the firm is actually producing cash or not. So generally speaking, again, if we're going to look at a hierarchy, you'd probably use price to earnings, so over price to book, over price to sales. And again, you would only use the price to sales if the other two are not working out because they're both negative. Generally speaking, when we're looking at all these three multiples, so we have in the homework we have 5 multiples. These 3 have essentially been the equity value multiples or the price multiple. So price and equity are the same thing in this particular instance. But we can also look at the enterprise value. So why might we want to look at the enterprise value? What is the difference between enterprise value and equity value?
Equity value is only the client that shareholders have.
Yeah. So what does that imply? So why would you then do a enterprise value?
Isn't it the unlevered?
Yeah, kind of, yeah. So it's gonna basically, if you have a firm that has a high or a low leverage and it's very different to their comparable firms, using an equity value will be quite incorrect. So generally speaking, when you're looking at your comparable firms, those multiples will be observed. So if I go back to, let's say, the equity value here, and I might look at the profits, for example. So the equity value in relation to the net profit, and I see that Zara has a multiple of 22.2, Uniqlo of 31.5. These multiples are based on the expectations about the future, but it also incorporates the associated risk. So some of these firms might have a whole lot more debt than others. If you have a different capital structure and you have a lot more leverage, you might actually need to adjust for it, and in that case it might make more sense just to look at your enterprise value as a whole. Basically remove any effects of leverage. The idea is that enterprise value allows you to better compare basically apples to apples, because when you're using equity values for comparisons, you're basically doing apples to oranges, assuming that there's different leverage between the firms. So the idea here is that you're essentially going to be looking at a metric that is more easily comparable across firms. Enterprise value tends to be positive, and generally speaking, when we're using it enterprise value multiples, this slide is particularly about the EBITDA, so earnings before interest, tax, depreciation, and amortization. The reason why people tend to use this is because this provides a much better understanding of what is provided to all the capital holders, in a sense that the creditors and the common shareholders. It's essentially it's before interest, tax, depreciation, and amortization. The idea is that EBITDA is supposed to be a proxy, or more or less an approximation of the cash flows. So instead of just looking at your cash flows, you're going to look at EBITDA. But the problem is, technically speaking, EBITDA tends to be slightly higher than cash flows. So people might say that instead of using EBITDA, you might instead compare it to the free cash flows of the firm. So again, enterprise value multiple, really just great for using when you have companies, specifically comparable firms, which have very different leverage amongst themselves or even comparison to you. And technically, you can do the same thing with sales. In a sense, you can look at the enterprise value in relation to sales. And generally speaking, it is better than price to sales, in a sense that a lot of the advantages and drawbacks of price to sales apply here. But the better thing here is really that it's better than price to sales, because enterprise value is the value for all the, I guess, capital providers, and sales is available to all capital providers as well. So there's no longer an inconsistency between the numerator and the denominator. And then finally, we basically have some issues that we need to consider within cross-country comparisons, because some of you would have chosen comparable firms that are in different countries. That's fine, because you almost always have to in order to find a good comparable firm. The only issues around here is when you have a firm that is being compared that is based on a different accounting jurisdiction. The reason for this is that there will be some consistent differences between accounting practices, and it usually results in differences in net income. So generally speaking, over time, what we found is that IFRS tends to report higher net incomes and lower shareholder equity values. Combine these two, it effectively means that the return on equity tends to be higher under IFRS. So if any of those multiples are based on return on equity expectations, or if any of those multiples, like price to earnings, uses net income, it might not be basically using an apples to apples comparison, because you are effectively creating some noise by having different accounting standards. Again, most large firms these days, or I shouldn't say most, but some of them might actually report both under IFRS and US GAAP, in which case you might actually see the differences, but otherwise it is sometimes almost impossible to figure out what the net income should be. So effectively just be mindful that if you are using comparable firms that are in different countries, that sometimes is a way to explain why the numbers might be different. So again, I did also already mention in a sense the idea that when we're using multiples, and specifically in index in a lot of different firms, sometimes it's not necessarily great to use an arithmetic mean in the sense that we're just looking at the average. We might use a weighted mean based on the size of the firm, in the sense that large companies might be weighted by their market capitalization so that they have a heavier influence on the average multiple. So again, that kind of sums up what we did. So if we're looking at the summary, we talked about price to earnings, which is great because everybody focuses on earnings. It's a driver of value. The drawbacks is really around the fact that if you have zero, negative, or very small earnings, it's going to be impossible to use this multiple because you need to have a regular earnings component. You also have some issues around transitory earnings in the sense that some earnings are one-off, which might also influence the multiple, and all the usual accounting issues around management discretion. We also talk about the trailing and forward PE in the sense that forward multiples are better because, generally speaking, when people buy shares and sell shares, they tend to do so based on future expectations. So a forward multiple in general is better, but if the firm has now changed from last year to the next year, it doesn't usually matter. Or sometimes you might even prefer a trailing multiple when the forward estimate is a one-off item, in the sense that the forward estimate or the future forecast of our earnings is based on one-off gains rather than permanent components. We did have some issues around calculating EPS, such as dilution of shares. We had issues around how do we figure out what is going to be a permanent versus transitory component of earnings. So trying to figure out what is the true underlying earnings, or even trying to normalize earnings when they fluctuate from year to year. And again, just like most of the other things, when we have huge differences in the accounting methods, there's going to be influencing the earnings per share because earnings is an accounting number. We then talked about the ways that we can select comparable firms. So we can look at few select peers, the entire industries, basically go a bit more broad, or even go to the broad market index. You might, in Australia, you might use the ASX 200, for example. Again, generally speaking, this is going to be the most relevant, slightly less relevant, even less relevant. The idea is that if you don't have perfect comparables, 2 or 3, maybe you might use a few more just to average out their differences. So even though you have 10 bad comparables, it's generally seen as better than 3 bad comparables. So the idea is that the error will get averaged out. Or again, your own historical values, which is great unless your firm has changed dramatically from the historical periods. We also talked about price to book value ratios and multiples. And again, price to book value ratio is generally good when the earnings per share is negative, so you can't use a price to earnings multiple because book values are almost always positive. They tend to be stable, and they are also very useful for firms that will terminate, in which case they don't actually have any forecasted future earnings. And again, when we're looking at price to book value multiples, the largest drawbacks are around the accounting issues, the fact that book value does not capture all the assets and liabilities of the firm. So things like intangible assets will not be there. Sometimes firms will try to put things off balance sheet, and sometimes even the things that are on the balance sheet might be valued based on historical costs, which might be vastly different from the fair value. So all of these things kind of create some noise in the actual book value measure. We then said that if we don't have the price to earnings and price to sales multiple, well, maybe let's just do a price to sales. Well, price to sales multiple is basically used when you don't have the other two, or basically when the other two are not positive or are not necessarily useful, in which case sales might be used. Again, it's going to be used primarily in this particular instance, and the big drawback here is really around the fact that sales does not tell you anything about the returns. It only tells you what the sales are, and technically the sales can be distributed both to the shareholders and the other capital providers, to the banks. So it might not be the best comparable metric to use to price, which is really the value for the shareholders, which is sales, which is again available to all the capital providers. And then we talk about the enterprise value multiples, which is essentially looking at the market value of stock and then adjusting it for like debt, cash, and investment and all minor things. So basically adjusting it for all the other capital providers. And again, the idea here is that you're basically trying to compare firms with different leverage. So if your comparable firms have much more debt or much less debt than you, then you might want to use an enterprise value multiple. And then finally, we talked about the cross-country comparisons in the sense that, generally speaking, there might be differences between IFRS and US GAAP companies, because IFRS tends to report higher net income on average and lower book values, which generally both lead to a higher return on equity. Do we have any questions? Easy? Not easy? Yeah. Like, I generally find that this week tends to be easier for people than the prior weeks because this is slightly less technical. It's basically just trying to understand in what instance do I use this multiple, what are some of the pros and what are some of the cons. If you understand that, then you usually can understand when to apply it. All right, so basically we're done. You can already start with the Thursday workshop if you wanted to. I don't mind that, and start working on your project. Otherwise, we're done, and I'll see you on Thursday. If you need help, I'll stick around and help you individually and see kind of where you are at. Again, I'll see everybody on Thursday.